Right, today the Bank of England has announced measures to increase lending. The bank's financial stability report stated a reduction in the amount of money banks need to keep in reserve, overturning measures designed to protect banks from failure in the case of a future recession. The news comes as the pound falls another 1.54% to below $1.31 to the pound. Joining us now is economist and wealth manager Jonathan Davis with his views. Hello, Jonathan.
Hi, Sam.
What exactly does all this mean?
It means that economically we're toast, and they're blaming it on Brexit. It's quite remarkable. It's totally pathetic. I'll put some meat on the bones. You know, before the referendum, they said, the guys on the Remain said, if we vote to leave, the pound's going to crash. And of course, the pound fell Thursday night, the night of the vote, and then it came back up again, and it's falling a bit. And it's because of Brexit, isn't it? No, it's not. The pound's been falling for 2 years, or 9 years, or 100 years, depending upon your point of view. It's certainly been falling for the last 2 years. It was then, 2 years ago, $170 to the pound. It's now, as you say, $130. It's got nothing at all to do with Brexit. The stock exchange doesn't care about Brexit. The government bond market doesn't care about Brexit. What the markets, what the economy cares about is the global economy, the US dollar, and Mark Carney and the Bank of England are excusing themselves from all their failures.
So if that's the case, then what can be done?
Well, the assumption in your question, understandably, is that something can be done. What the media in particular forgets is that, for example, you talked about banks there. He's making it easier. He's overturned rules to secure banks if there's another banking collapse. Overturned rules. Do you know the size of the banking sector? You will not believe this. It's 5.5 times the size of the UK economy. That compares to the US banking sector, which is 0.9 times the US economy. This country is in effect one big, massive hedge fund, massively leveraged, massively over-indebted. The assumption in your question is something can be done. Nothing can be done when you get into this state after 25 years of getting into this state, pretending that nothing's wrong, kicking the can down the line, bailing out the banks 7 years ago with our borrowed money. All they did was they created an even bigger problem, and that's where we're at now. I'm afraid we're moving into a global economic depression, and it's very likely that next year the UK will be in recession. And the big existential problem is that they can't slash interest rates, which is what they've done every time there's a problem in the last 40 years. We're in economic depression pretty soon, I'm afraid to say.
Mark Carney implied in his last speech, he's making a lot of them at the moment, that interest rates being cut was something he was definitely going to look at soon.
Oh, yeah, absolutely. The idea that the central bank leads interest rates is a myth. The markets lead interest rates. The markets have been pushing down interest rates consistently, for the last 35 years, depending on your point of view, or specifically for the last 3 years, and the central bank has to follow what the market is doing. That's the reason why interest rates are going to fall. And why are interest rates falling? Because economically we're toast, and they're doing everything they can to keep it at bay until the inevitable. They'll not just go to 0.25% and then zero. These mad and bad guys in the central banks is the phrase that I use. They will take us to negative interest rates. That's how ridiculous it is. That's how dire the economic situation is. If I had said to you 15 years ago that we are going to negative interest rates, those who understand what that means,
I want to understand, because that sounds to me like I borrow money.
Reality.
That sounds to me like I can borrow money from the bank and rather than have to pay it back in full plus interest, I pay back a bit less than I've actually borrowed.
There has actually been an instance in the Eurozone where a mortgage went negative such that at the end of the year, the lender paid you some money back.
Yes.
Absolutely astounding. To which
you're painting this as a bad thing.
Woo, wow, that's fantastic.
That's more or less what I said.
Negative interest rates, I'm going to be quids in. What you need to realise is we have no inflation, and yet we've had practically zero interest rates for 7 years. So-called emergency rate. Do you see an emergency? And it's deflationary. If we go to negative interest rates, it will be super deflationary. And Sam, in a debt-fueled society and economy where asset prices, shares, property, residential property has all been fueled based on debt, the last thing you want is deflation. And that's what negative interest rates is going to give us. Unfortunately, negative rates is going to put us even more into depression. It's not going to help. It's going to exacerbate.
You've terrified me and all of our listeners. But listen. Let me get you to end on not necessarily a positive note, because I'm not sure you've got that in you right now, and rightly so from what you've said to me. What can we do now, individuals?
Yeah.
By individuals, I mean specifically me.
Great
right?
question.
What can we do
Absolutely
to protect ourselves?
And that's the issue, because the elite, the political financial elite, will not help us. What the likes of Mark Carney is doing, he said, I will do whatever it takes to help the economy. No, he'll do whatever he needs to do to help the banks. He's not going to help you and me. What individuals need to do, and it's easier than said and done, I appreciate that, is they need to get out of debt, because I'm telling you, we are moving to deflation where wages may not fall, but they certainly won't rise. But in deflation, the real value of your debt will actually rise because money grows faster.
Yeah.
The level of your debt will rise in deflation. The last thing you want is higher and higher debt. So somehow reduce your debt. And if you're in the stock market, that's where the bulk of your money is in your pension. Well, I would seriously look at that. I would talk to your advisors, your stockbroker, because I'm telling you, the stock market is not going to like deflation.
Thanks ever so much, Jonathan. We've ended on a semi-cheery note, as cheery as we could get, but we appreciate your advice and your insight on that, as Jonathan Davis there, economist and wealth manager, with a rather bleak response to the Governor of the Bank of England's announcement today.